Welcome to the special presentation this week titled Become a Better Investor. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be providing your presentation this evening. As Dr. DeLito related in the Little Green Book, Stock Strategies and Common Sense in Chapter 21, he wrote, "Knowledge is power. Power is the ability to get things done. Knowledgeable investors have the power to know when to buy, what to buy, and when to sell. They keep risk under control and manage their portfolios for persistent profits. The secret to becoming a better investor is to know what you're doing and increase your knowledge and experience over time." VectorVest offers many features to help you become a more knowledgeable investor. Just off the top of my head, I compiled this list of some of the educational opportunities we provide our subscribers. Every day we produce the Daily Views, which reviews our market timing system signals and gives us daily guidance. Every week, Dr. DeLito writes an essay. And of course, all of those are archived back to 1995. Daily color guard reports are offered every evening to recap the day's action and include our very popular Goldbug's timing study and our hot stock picks for the day. We offer special presentations just like this one on a weekly basis to do a little bit more in-depth examination and demonstration. We have special reports written on special topics within the Views tab. We have multiple live coaching webinars every week. We have local and online user groups where our users get together to share ideas. Of course, we have paid courses to offer really focused learning. And we continually develop new special projects and contests to get our users involved. Currently, we've expanded our hot stock picks feature into a contest for our user groups titled the User Group Hot Stock Picking Challenge. This, of course, is in addition to the information and analysis provided by the program as a resource. I'm not trying to sell you anything here except the motivation to do something. Join a user group, enter a contest, get involved. Never stop learning. The knowledge and experience gained all accrue to you. This presentation is no different, and so tonight, I want to use tonight's opportunity to talk to you about Moneyball. What? Did that get your attention? Well, have you seen the movie Moneyball? It was based on the book Moneyball, The Art of Winning an Unfair Game by Michael Lewis. It's about the Oakland A's baseball team and its general manager, Billy Beane. Its focus is the team's analytical, evidence-based, sabermetric approach to assembling a competitive baseball team on the cheap. Perhaps you caught the similarity to VectorVest's analytical, evidence-based approach to portfolio management. It's the story of knowledge versus intuition, and it provides a great framework to think about our team, our portfolio. In baseball terms, this sets up the question, are we better off swinging for the big gains as a home run hitter would, or looking for consistent winners like a contact hitter? Home run hitters score runs quickly, but they also strike out a lot. Contact hitters get on base a lot, but they grind out their wins more slowly and often leave men on base. Intuitively, particularly when we're first starting to trade, most of us focus primarily on making gains and avoiding losses. Naturally, we focus on our winning trade percentage. Of course, the higher the percentage, the more we like it. Now don't get me wrong, we have no problem with taking winners, but this can incentivize taking profits early to improve our winning trade percentage, thus keeping our winners small. This may work for a short period of time, but eventually we'll suffer a big loss that wipes out much of our gains, or we'll hit an unlucky streak of losing trades that really knocks us back on our heels. Okay, we think, well, let's work on the problem from the other end of the equation. Let's focus on getting bigger winners. They'll cover our losers. This incentivizes trading more volatile stocks and or holding for longer periods of time to get bigger gains, exposing us to more market risk. Now our win rate falls, and even the odd big winner may not be enough to cover our string of losses. So which is it? Which is the better approach, swinging for the fences or swinging for first base? Well, the answer is yes. The truth is both approaches can be successful and both can fail. The key is to align your temperament and your approach. So who are you as an investor, and what kind of stocks do you like to trade? Are you risk-averse, more conservative or prudent? Stocks with solid fundamentals that make slower although steadier gains? Or are you comfortable with a little more risk? You're more aggressive or speculative? Willing to trade stocks with weaker fundamentals that make bigger and faster price swings? Well, for more information on that topic and to help you answer that question if you don't know, let me refer you to the Special Reports section on our View tab. There's a special report on the investment temperament matrix. So broadly speaking, our contact hitters will have higher winning trade percentages but a lower reward to risk ratio. Our home run hitters will have a lower winning trade percentage but a higher reward to risk ratio. By themselves, your winning trade percentage and your ratio of reward to risk don't tell the whole story. What really matters is what happens when you combine the two to determine your trading expectancy. So let's define trading expectancy. Expectancy measures a trading strategy's profit potential. It considers both the reliability or win rate percentage as well as the amount gained by each win. That way you can compare trading strategies that often win small gains with strategies that rarely win but win big when they do. Higher expectancy scores are better and will always avoid trading strategies that have a negative expectancy rate as their sure losers. Using this tool can give us insight on our current trading plan performance or to compare different plans. So let's take a look at the math. First, to do the math, to calculate your trading expectancy, you'll need to know your win-loss percentage and the size of your average win and the size of your average loss. The calculation is comparing the average win size adjusted for its probability to the average loss size adjusted for its probability. Of course, to be profitable, our winners need to outpace our losers. Remember, we're dealing with averages here, and we want to measure how our system works over time. So your sample size needs to be large enough, 30 to 50 trades minimum, to be relevant. This tool will help us analyze any of our existing trading plans, but also analyze any new trading plans or modifications that we want to make to existing plans so we can do an A/B comparison. Simply paper trade your modified or new trading plans with enough trades to test them out and compare them to your existing plans. So let's try it out. For my examples, I'm going to use our common benchmark for portfolios. It's a $100,000 portfolio trading 10 $10,000 positions, risking 1% max per trade or $1,000. For our thought experiments, I'm going to keep the numbers round to keep the math easy, but of course you would plug in your own performance data from your portfolio. So here's our expectancy formula, and this is now the data point for a 50-50 trader who has a 1-to-1 reward to risk ratio. So we know by definition our maximum risk is $1,000. So our average loss size is at 1,000, and if I lose half of the time, then my probability adjusted average loss is $500. Now since I'm a 1-to-1 trader, I have a reward average win size of $1,000. I win half of the time, and so my probability adjusted reward is $500. 500 minus 500 equals 0. So with an expectancy of 0, this plan would not make money over time. Imagine further that while you're trading this plan, real life happens. Things like slippage and commissions or mistakes that you make, market reversals. Maybe you have a cluster of losers or a string of losers that knocks you back on your heels. It's clear we need more profit margin for this trading plan. And this calculation allows me now to explore what-if scenarios to modify my approach. So now I'm exploring the same trader, still a 50-50 trader, but now we have a 2-to-1 risk to reward relationship. Of course, assuming we'll be able to maintain our 50% winning trade percentage. But let's run through the math. So our average loss at $1,000, I'm a 50-50 trader, so that's still $500 on a probability adjusted basis. The winners, however, now with a $2,000 average win size adjusted for our probability has an expectancy of $1,000. 1,000 minus 500, we have an expectancy of $500 per trade for this model. That gain represents a 5% return on our $10,000 investment, or a 50-cent return for every dollar of risk that we take on in the portfolio. And in fact, I noticed that my winning trade percentage could fall as low as 25% before I reached my break-even point, so I have a lot more cushion in this scenario. And of course, anything I can do to improve my winning trade percentage or my average win will improve my expectancy, as will anything I can do to lower my average loss or lower my percentage of losers. So let's look now at something a little more extreme. Let's take a look at our home run hitter. So same portfolio setup, same maximum risk setup of $1,000 per trade, but now we're a 20-80 trader. We win 20% of the time, 1 out of every 5 trades. And I recognize that may be a little generous because home run hitters now are doubling the stock price, right? So we now are risking $1,000. The probability adjusted loss is $800 per trade. But our win size now, because we're hitting a home run, we invested $10,000, we've made $10,000. The probability adjusted win is $2,000. $2,000 minus $800 gives us an expectancy of $1,200. Very nice. So yes, you can make money winning only 20% of the time. Right? Your gains just need to be big enough. And they need to dramatically outpace your average loss. And that's not a small point. These studies are assuming that you can actually attain this level of performance. It's simple, you just need to hit home runs, right? But remember, we also need to consider who you are as a trader. What's your temperament? Are you a risk taker? Could you sweat out a string of 8 losing trades on your way to the next big winner? Could you sweat out the volatility of the stock's price swings on its way to doubling? Oh, and by the way, if your winners fall to 1, winner out of every 10, your expected gain falls to $100, or 1%. Okay, you optimists, if you could win 50% of your trades on the other side, sure, you'd make more bank. But remember, we're looking at averages. You would need to be able to sustain that over time. So now we can see why speculators tend to have more volatility in their portfolios. And finally, let's take a look at the risk averse. In this setup, we're taking our winners early and therefore win most of our trades. In fact, 80% of the time in this example. Our reward to risk in this case was back to 1 to 1. So our probability adjusted gain is $800. Our probability adjusted loss is $200, giving us a net expectancy of $600, or 6% on our $10,000 investment, or 60 cents for every dollar of risk. Temperamentally, this feels much safer. We're winning the majority of our trades, portfolio volatility is lower, but so is growth. Our margins are thin, so our margin for error is thin. We're at risk of a situation where we hit a cluster of losses that become difficult to recover from, particularly if it happens early before the averages kick in. And remember, our real-life factors like slippage, commission, mistakes are all still out there looming for us. So yes, we can have a high win rate and still lose money. So in conclusion, trading expectancy is a helpful tool. There are other factors that come into play which can complicate things a bit. So it's not an all-encompassing tool, but you can gain some great insights into your trading system. The takeaway here is it's the interaction between winning trade percentage and a reward to risk relationship that creates wealth. Expectancy measures a trading strategy's profit potential and gives you great insights into your trading, making you a better investor. Because remember, knowledge is power. Thanks for watching.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.